Hey guys, welcome to the channel Market Uncharted. In today's video we are going to speak about bonds. So if you are looking at the macro environment on the last few months, you have seen that the yields are starting to come out. There is a possible of recession and potentially the decrease of interest rates and more quantitative easing. All of that potentially increases the investment in bonds. So in the next couple of videos we are going to discuss about what is bonds, the different type of bonds we have, why it's a good investment to have in your portfolio, and overall what the potential benefits it is for your portfolio as well. So let's start the video with what are bonds. So a bond is an issuer obligation, which means a debt to pay a fixed amount of income, a coupon, plus the principal at predetermined dates. Since bond investors are entitled to fixed income streams on specified dates and hold a senior preferential claim, investments in fixed income are generally less risky than equities and commodities. However, when buying equity, the investor becomes a shareholder of the company and participates in the distribution of profits. Bonds can be issued by companies as well as sovereigns and are traded either publicly or privately. So here you can see in a quick graph what is a bond. It can be issued by a government or a corporation. The potential is to generate funds. So basically the company issues debt to invest in their own product or R&D, etc. and then pays back to the investors via principal plus the interest. So it means that once a bond is issued, it can be issued like, for example, 99% of par, and then at maturity date pays 100%, and during the time of the bond pays the coupons yearly or every 6 months. So it's important to understand the sources of return from bonds. It's the contractual coupon interest, where basically the company or the sovereign says, I will pay X amount per year. Then you have the capital gain or loss. Here is when you invest 99 to receive 100. And then you have the reinvestment of income on coupons received. So basically the returns that are earned during this investment, and then you can buy more bonds. Then why buy bonds? So basically two main situations. The number one is get a reliable income stream with a lower risk than in other asset classes, because when you buy equities every day you are subject to the change of the price itself, and the company can go bankrupt. While you buy bonds, you just are entitled to the debt that you loaned to the issuer of the bond, and then you get the coupon. So basically here just an illustrative example of a government bond to understand how this works. Let's imagine point number one, the government issues a bond which is purchased by you, the investor. For example, at that moment the government receives $1 billion and issues bonds. Step number two, the bond may be then traded with other investors. That's what we say the secondary market, where the bonds are each day traded, and then up to maturity date we expect to receive 1.01 billion from the government in the exchange of our bond. So basically the bonds are risk-free rate and coupon mechanics, because we intend to understand that if a government goes bankrupt, the percentage of the likelihood of this happen is very low in comparison, for example, to a company. So that's why, for example, the North American US bonds are considered as risk-free, because the chance of America to go bankrupt is very low in comparison, for example, with another corporate like ExxonMobil or Apple. So bond prices rise as interest rates decline and fall when rates go up, so that's an inverse relationship. This is measured by duration, which measures the sensitivity of a bond price to a change in interest rates. Long-dated bonds react more to interest rate changes than shorter-dated ones. Because a bond is more or less attractive, the longer shorter it earns a coupon above or below the market yield. So let's address coupon mechanics. At issuance, the coupon is typically set to that leads to initial bond price around par, i.e. 100%. At par, the yield of a bond equals the coupon, which means that the investor only gets what the company or the sovereign pays as a coupon. Assuming a constant risk premium, a fall in the risk-free interest rate enhances the appeal of a bond, whose coupon appears favorable in light of the new market conditions. What I mean is, if the US government pays an interest of 1% and we have a bond paying 2 or 3%, as long as this happens, our bonds are more attractive than go and buy the treasury from the government. So the bond prices appreciates, forcing its yield back in line with the fair market yield. Conversely, a rise in the risk-free rate will lower bond prices. Why? Because if your risk-free rate, again, the US government, gets more attractive to buy, why speculate on a different corporate or other sovereign? You should go to where is more risk, in this case risk-free. Once purchased, a bond's value can vary throughout its life until maturity due to fluctuations in the underlying obligatory's credit quality, which means when you buy a corporate bond, their credit rate actually has a very huge impact on the price of your bond and the coupons then the company needs to pay to the investors every time issues new debt, because this is correlated with the chance of going bankrupt. These fluctuations may cause a security to be valued at more or less than initially paid should the investor sell their investment prior to maturity. Again, because bonds are quoted every day on the markets, if the likelihood of bankrupt increases during the maturity or before the maturity of the bond, this actually has an impact on the price of the bond. So let's understand also prices of bonds. So every time I say a bond is at discount, it means the bond is below 100%. So it's below par. Every time this is at a premium, it means it's above par. And if we say it's at par, it means that it is at 100%. Positioning. So basically, investors throughout time usually buy short-dated bonds if medium to long-term interest rates are expected to rise against short-term rates, and if the yield curve is inverted or flat. Investors usually buy medium-term bonds if medium to long-term interest rates are expected to remain flat or rise slightly compared to short-term rates, and the yield curve slopes upward or it's flat. Usually, investors buy long-dated bonds if the long-term interest rates are expected to remain flat and the yield curve slopes upward, or the short-term rates are expected to increase more than long-term rates, or long-term rates are expected to decline and the yield curve is flat. Now that we understand how it's pricing, how it's above or below par, it's also important to understand that the majority of bonds are actually having risks. So let's go throughout some of the risks with bonds. The risk premium basically is, as stated earlier, the bond yield is composed of the risk-free interest rate plus a premium to compensate for bond-specific risks. There are several types of risks besides interest rate-related risk, including credit risk, liquidity risk, supply risk, and risks from technical factors. So risk premium components. In this section we focus on risk premium drivers, credit risk, liquidity risk, supply risk, and other factors. Let's start with credit risk. Credit risk is the primary determinant of risk premium. It is the risk that an issuer will be unable to meet all coupon and principal payments on time. If unable to do so, the issuer is deemed to be in default. So basically, when you buy a bond of a corporate, you are expecting that they can pay the coupons and at maturity give you back the money you invested. If for some reason this is not possible, we consider a technical default. So when it's perceived by the market that this credit risk premium is increasing, it means that the probability of a default is higher than it used to be. So take a moment right now and pause the video so you can read through all the important parts of the credit risk. Then you have liquidity risk. Liquidity is a major issue in the bond markets. While not being able to buy a bond because there is not enough liquidity is an inconvenience, far more critical is not being able to sell a bond when its credit quality deteriorates, which exposes the investor to uncontrollable risk. Then we have the supply risk. The bond market is dominated by institutional investors like mutual funds, pension funds, and insurance companies. Most have limits on their exposure to single corporate bond issuers. So an issuer with a large volume of outstanding bonds may have to offer a more attractive yield to find buyers for new bonds, even if its credit quality does not decline following the increase of debt. The additional risk premium depends on how overrepresented an issuer is in certain currency or maturity range. The added supply represents an opportunity for investors not exposed to the issuer, but it can also hurt a bond performance. Existing investors of the issuer may decide to exit their position and opt for the new issuance with a higher yield, putting a downward pressure on the price of the issuer that was previously done before. Then we have some other technical factors. Again, please stop the video to read through it, but I will just go very fast on these ones. Most countries apply higher taxes, so taxes is also important on the bonds, sales restrictions, and issues that are unrated by the major credit agencies. So for example, Moody's, S&P, and others rate the credit risk of each bond that issued in the market, and those that are unrated can take on more risk than the others. So just a small summary, think about this, the types of risks that are in bonds, and overall in the next few videos we will discuss many others, but these are the main ones. So credit risk, which is basically the probability of a default, reinvestment risk, interest rate risk, and liquidity risk. Okay guys, thank you so much for watching the video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.